somebody. There they are.
Right. Good evening. This is the Finance Committee meeting, July 15th, 2014. We're going to start off tonight with a presentation and request, I guess, from Michael Crory regarding turf fields.
Yep. My name is Michael Crory, resident of New Estate Road in Littleton. A group of us have been meeting for a couple months now, and we're having an issue with field space, lack of it, I guess. And, you know, there's been talk of the Morgan property and things like that. But we're trying to get turf fields put in place in town. The ultimate goal would be three fields. What we have here is, this is the Littleton High School, and we'd like to turf one field right here. This is the alumni field, which the football team plays at right now. Girls lacrosse, and they have some night games for soccer and lacrosse as well. But we'd like to turf that, and the wish list would be, this is a modified field where youth lacrosse, youth football plays, and Kevin Hunt is actually, he's kind of highlighted this in green. This is not what these fields look like. If you can see this patchy area, this is dirt where, you know, the kids a lot of times go through there and they're scooping up rocks with their sticks and throwing rocks. It's tough for them to play there. We try and shift the field every year to, you know, minimize the damage, but, you know, youth football will jump right back on that August 4th, and, you know, a 4th, 5th grade team, a 6th grade team, a 7th grade team, and an 8th grade team. We all practice right here, and we try and alternate, you know, after the 4 nights a week we get to start, we alternate 2 nights a week, each of us.
When you say turf fields, what does that mean?
Synthetic turf.
Okay, that's what I'm...
Yeah, okay, synthetic turf. Straws of, you know, fiber with recycled rubber and a sand mixture combined in there, which makes the tines of the fiber grass stand up. That needs to be brushed, you know, maintenance maybe once to twice a year, depending upon how much we decide to use it. We're estimating these 3 fields to be around $1.8 million. To do the 2 main fields, the high school field and this field would be around $1.4 million. You know, the advantages to this are, especially at the high school level, the high school teams are producing quality teams which go deep into the playoffs or district tournaments. And the minute they get out of the Littleton area, they have to play on turf fields, and they're at a disadvantage, especially lacrosse. The game's faster. The ball bounces differently. Field hockey, the ball is moving so much faster, and they don't get to practice on it all year. Football, same way. This game changes. It becomes a lot faster. Everything's moving faster. The boys all went, you know, got to go to Gillette this year, and I think they played in like 2 turf games, and one at Gillette and one right before that. And the youth programs, obviously, we get these fields after the high school's done with them. You're looking at 400, let's just say 450 in the fall. I think it's a little bit more in the spring, or vice versa for soccer. There's 200 athletes that, youth athletes that play lacrosse. That's girls and boys in the spring. You know, this also takes away from no more watering, no more fertilizing, no more pesticides. Nothing has to treat these fields. No more spraying. The highway department is done, you know, minus the 1 or 2 times a year we go out and brush it. And whether they do that or we get the turf company to do it, you know, we can decide that later, but they don't have to worry about maintaining those fields anymore. They come pre-sprayed, pre-lined, ready to go. They roll them out, and they're good to go.
What group are you representing here?
This is just a group of turf, we're just a turf committee or turf group that we put together. I'm not representing, I am the president of the LAX Littleton Youth Lacrosse Program. I also do sit on the Park and Rec Board. I'm not representing either one of those groups. This is solely a turf group that we put together to try and get turf
Okay.
brought into town.
So like the track group
Yep,
that got
yep,
together?
Yep. Very similar to that, but our problem is we can't wait. You know, this winter was a long winter, and spring sports, we sat in the gyms at the high school, middle school, Russell Street School for a month longer than we should have. And, you know, that, I know that's what it is with New England, but we can clear these fields and we could play on these year-round. Savas was in discussions with us about the light department putting lights up at the high school. So that would be another, you know, a little bit extra revenue we could generate after the youth sports are off, that they could, you know, keep the lights on a timer until 9 p.m., and we could rent the fields out to generate money. I know Acton just built four turf fields, which are, the town gets it till X, let's say 6 o'clock, from 6 to 10, this soccer club gets it, and they pay a good amount of this, you know, the cost of these fields that were built. You know, those are options of ways to recover money that these fields cost. And obviously, you know, to build these fields, to build new grass fields, you're looking at $570,000 for a grass field. You know, when it's all said and done. Drainage, new loam, seed, then it sits, germination, wait time. You know, with the turf field, it's around $750. But once they're down, they're good. You're good. We're playing. 60 days. They call it a summer slammer. They come in as soon as we're done in June, and they're up and running for fall sports.
What kind of shelf life do these things have?
So these are 10 to 12 years, $100,000 to replace just the turf. So we were thinking that, you know, with the money we generate, or however they do it, they could put X amount of dollars aside every year, so that when a time comes, you know, we try and stagger the replacement of the turf, and that's how, you know, you just the turf. 20 to 30 years for the drainage, so the underneath, which is drain pipe and like a foot to 8 to 12 inches of stone, crushed stone, which is your drainage layer.
So would you elevate the playing fields?
No,
You'd
you'd
have to excavate.
you'd excavate it out,
Yeah.
and it would all be right, same level.
Okay, and how did you arrive at the cost?
Those were given to us by a guy
Who
who
does that?
does this, yes. Yeah.
And how do you envision paying for it?
Well, that's why I'm kind of here, to think, you know, see what you guys think. School committee, you know, we went to them, they support the idea of putting turf in, obviously. Park and Rec supports it, the highway supports it. How we pay for it, I don't know. And that's why I guess I'm here.
Yeah, and I don't know, you know, all those folks support you, that's great. They honestly should be leading on it then. It ought to be in part of their capital plans. We got, it's great that you and Kevin and the other folks have done that. I think it's long overdue. I know other towns have done similar fields. I'm not sure how we could do it other than a debt exclusion, but that being said, that, you know, your job isn't to figure out the financing. Once you get the town to support it, then it's for other folks to do that. But I just, it's unfortunate that, you know, you're coming forward as a citizen, when the boards, if they're all backing it, they should be making it part of their process. And our budget process begins in a couple of months, and that has both the operating and a capital component to it. I'm sure Bonnie can, if she hasn't already explained that to you, but if it's going to be serving the needs of the schools, Park and Rec, or be it, townwide function that the selectmen would back, then all those folks ought to be
Ought to be here.
they ought to be here, or they ought to be giving you the direction. They ought to be making it a part of a priority in their budget plans, et cetera.
Well, to be blunt about it, this has the same scent at a 6 times scale as the track. I mean, the schools wanted it, the highway department wanted it, everybody wanted it, but it was basically the ad hoc committee that drove the thing. And, that we got through, but, this, at this price point is a different situation. And again, I applaud your being here, and it's the right thing to do to raise the issue and to try to get people to support you. But for 1.8 million in these times, when we're looking at some other big projects that are coming down the pike here, I agree with Paul on this one, that, there should be 3 people sitting beside you, and I guess one of them's flat on his back, so we couldn't expect him to be here.
Usually he would have been
Well,
here.
he would
would've
have
been
been the
here,
one to be here with you. But, I mean, should we put a recommendation back to the school committee and the selectmen and Park and Rec to get together as a group and see where it fits on their priority list?
Just hate to
Because
create a
you're-
scenario, and I
yeah.
think we're in agreement here that it's somewhat cynical, but for those folks, they might have other priorities. Well, let you guys go out and fight for the money for that. We've got other things we're going to worry about. Well, if they're truly invested in it, then it ought to take a place in the budget deliberations with everything else. And again, that isn't back to you, except that if you're in contact with those folks, then, maybe you ought to relay back to, hey, we've been to the finance committee, and there's general interest in it, but, our role is kind of, once boards have adopted a project they want to see go forward, well, I suppose technically, citizens, if no board's interested, are perfectly free to go ahead and do one too, but that's not the way the budget process is designed to work when it's specifically going to be on town property, used by town departments. Those are the folks that should be in here. And maybe Fred's right, maybe we should send them a memo saying, hey, we had this proposal presented to us, sounds good, it's been indicated that you folks are in support. What say you? Are you on board? Are you putting it into your budget plans or whatever? And I don't know if that is helpful at all or not.
You also get some,
It would have to be through the PMBC.
Yeah, I mean, again, a project of this scope, certainly.
one of the things that you get with these folks, and especially the highway department, but also the schools and Park and Rec, is they can provide, from the highway side, the kinds of money that gets saved by doing this. You alluded to all the field work that they have to do, and at some point, they have to redo an entire field and what it costs. Those are the kinds of things that make a project like this seem less onerous in terms of dollars, in that it's going to cost this, but we're going to save this time, and then 10 years from now, and again, 15 years from
I
now.
agree with Alan.
And those are the kinds of things that you'll get from,
Analysis.
Yeah, absolutely.
yeah.
Right.
Did you say you'd been to the selectmen, Mike? I know you
On
mentioned.
the 28th.
Okay, so you are going before those folks. Good, all right. Maybe maybe if someone there takes ownership on it, then they'll kind of coordinate, improperly so. I mean, we don't really run any department. We just kind of work with everybody on their finances. But frankly, it wouldn't be right for us to step ahead of any of those departments and say, we're going to start making decisions for you.
I tried to get on last night.
Right, okay.
We go.
But it's perfectly fine to at least let
Yeah.
us know
Okay.
that there's a project like that out
Wish more
there that
folks would
people
do
are
that.
interested in. The more information we get, the better.
And, and where it fits on their priority for capital spending. I mean, the capital list is longer than we're going to fund in the next
Right.
eon. And if this bumps other things, and so be it. But If it can't, well, then we ought to go back and say, no, we have to do X, Y, and Z instead of this. But, I mean, I think it's a worthwhile project, I really do, but against, what's the alternative pain that the town will take because of it?
I just know in Chelmsford, they put a couple fields in, just recently did McCarthy in the high school, and they worked with the Pop Warner and Sal Lapoli, and I believe they started out with they did a lot of fundraising, got like half the money, and then the town matched the other half. But they also put together like a turf field committee, and I know like the school business manager and some town park and rec people, the Pop Warner people. I think that's probably what you need to start with, is get a committee together and kind of get organized and get some solid numbers and just, I guess.
They've done that part, right?
I mean, have you got a committee together? I mean, or you just, it's just you and Kevin and whoever else?
Group.
Yeah.
It's a group.
So-
I mean, it's basically the athletic director, along with all the youth heads, basically, all the youth groups. So baseball, lacrosse, soccer, football.
Okay. Well,
and
that's
Jimmy
a lot,
Clyde's.
that's a lot of votes that you can bring to town meeting, to be
Right,
perfectly
right.
blunt about it. But
I know.
I think what needs to happen is it has to be vetted with the selectmen in the school committee and the Park and Rec, so that they can, they have due diligence that they need to do to balance this need against the other needs that the town has right now. And, I don't see why it shouldn't get a fair shake, but, I think that's just the way it needs to go.
I think the folks that led the effort for the track, it took them a long time, but they organized it correctly, and you could take a lesson and
Right.
sit and talk with them about how they did that. And one of in your case, you can show savings someplace. They couldn't show savings. They could show we get a better product at our athletes, but you can actually show that if you spend this money, you'll save some of it over here. And I think that's a leg up for you. But I would talk to those folks, because they knew what they were doing. They learned a lot of lessons in doing it, and they were successful.
Right. I mean, that's the only thing, I mean, we don't have time, time. So if this doesn't go, it's a whole nother season, and we can't really shut any of this down during school seasons. I mean, I guess you could do it between December and the start of spring, if they could ever break through the frost and do all the work they needed to do. But, I mean, it's just, I know, like you're saying, time and how long it took the track to get going. One thing with this, we just don't have that much time.
But
I need to get this group going.
What do you envision as the timetable for this? I mean, next summer?
Yes,
So,
yeah, as soon as they were off in June, sports will be off in June, 60 days. Like I said, it's a summer slammer, they come in, they get it done in the summer, and it's ready to go for the fall sports.
Well, just so that you know how things actually work, for something like this, for the town to put any money into it, it's going to end up at town meeting.
Right.
Right.
And between now and next summer, you only have the fall and the May town meeting.
Right.
So you got a very tight,
Right,
Why?
and that's why, I mean, we've been talking about turf fields for years. We finally started to meet about turf fields this year, after the winter, and spring came around, and we started to finally meet and sit down and talk about it, and we gotta get going. And we've all expressed that we gotta get moving, we have to get moving. And, I know it's tight to get on the fall meeting. I don't know if we'll get on the fall meeting, but,
The fall meeting,
I'm
the
not
difference
worried-
between the
I'm not worried about the
fall
meeting.
and the spring meeting in terms of starting for a July 1st construction schedule next year wouldn't make much difference anyway, so.
Okay.
That's your own decision to make, but I mean, I think between tonight and 2 months from now, when the budget process begins in earnest, you get plenty of time to get around to get all the boards, kind of make them take a stand, see who's gonna take leadership, are they gonna sign up, they're gonna make it a priority in their own spend, because they're in the process now of
But what if
each
no one-
developing their own priorities. If they
What
all
if they
back
don't?
off,
Yeah.
You still have a right as a citizens group to go forward with it, just it's a little more complicated, working it into things. And it's the last thing we want to encourage is for boards to say, boy, that's a popular, expensive item, but I don't want to waste any of my capital arguing for that when I have other little pet projects I want to do. So we're going to have this backdoor process, you avoid all the departments, not that you're doing that, but, departments by not acting on it, maybe encouraging that behavior, which is not the right way to go.
Right, I've seen
Wouldn't the
it.
Park and Rec have to kind of take the lead on this? And who's gonna manage it? It'd
It
be
sounds
them,
like
right?
schools would have as much use of it anyway than.
Yeah, but who would manage it though?
And the
Probably the
schools
Park
would
and Rec.
have more use.
Who would manage it though?
You're having the same discussion for $1.8 million that we had for $300,000 2 years ago. And everybody hid under the table until the track was built. And then they all came out and pounded their chests at how wonderful it was. And what I really think we should do is put pressure on those boards to step up and say they want to support it, and it's important enough to bump something else that's on their list.
Where is this in your priorities?
Yeah, absolutely. I mean, for $1.8 million, you ought to be able to get their attention. And I applaud you coming in here. I think being on the selectmen's agenda is exactly the right thing to do. I would, if you haven't already got on the school committee's agenda, I would do the same thing. And if you have a group of people, I'd bring a couple of friends with you. I really think that try to build the groundswell of support is, for that kind of money, I think we have to do that.
I don't want you to go away from here discouraged.
No, absolutely not.
Because I think what you're trying to do is a really good thing and a good idea. But what you're being told here is take the advice, it's good.
And the specific ask ought to be, do you support it? Well, that's an easy yes. Do you support it, and will you advocate for it in your budget and capital requests? And that's the real question. If they'll do that, well, then they're on board, and we go about the business of trying to fit it in with everything else.
Sure, absolutely.
Okay.
Thank you.
Should we send a note to the selectmen saying we've met with him, or do we want to do that? And we're curious to see where the selectmen are on it, or?
Hear from the rest of the
Yeah,
board. I mean,
I'm just echoing what you
we've
said.
done that in the past when issues have come up, just said Mike came before us, and we feel that, these three boards and Jimmy's department need to opine on this, and for $1.8 million, we need everybody in the same canoe rowing in the same direction. Please help or opine on it. That's what I would do if it was my choice.
I agree.
I mean, you can decide to do it or not as a committee, but that's what I would do.
I mean, I definitely support it. I mean, I don't know what we do from here.
We support like everybody else does, it's not coming out of your pocket, that's the problem, right?
Well, yeah, and I think maybe breaking it up might help as well. I think trying to push it through as, 1.8 million and let's get 3 fields done at once, I think is gonna be hard to accomplish. I think maybe breaking it up and phasing it in might, make it more sellable, I guess.
Just before you go, and so the reason, like, 2 fields is this field, this alumni field, and this high school field. To do 1 field, it would be a mistake. Just the overuse, it would be every team from every high school youth trying to get on it, it'd be a nightmare.
No, I mean, what about?
You know what I mean? But if you did 2 and then 1,
But look at all the money you can possibly generate. I mean, what are you gonna charge all these youth organizations to use the field? Obviously, you're gonna increase your
Well, it's
fees for
a case of not
synthetic.
being, you wouldn't be able to get everybody, you couldn't fit
I
it in
couldn't
the
throw
budget.
everybody on
Yeah.
there, but you
You
can
couldn't
generate a whole lot
schedule
of
it.
money.
Right.
In that 1 year, and then that goes towards, the phase 2 and phase 3 and the next couple of fields. And
And I guess then the question that pops into my head, listening to what you were saying, how far behind it is Kerper Field?
from what I was told is they don't want a turf Kerper.
Who is they?
Gary Austin. I think he's president of youth soccer, correct?
Okay, I don't know.
Well, he's attended the meetings for the turf committee.
Is that the one over by Light and Water?
Yeah,
Yes.
no, it's just, you know, it
They-
just seems that, you know, once they start, then
Himself and
are we looking at another 600,000?
Cheryl Crowley
Okay.
have both attended, and they do not want to put turf on.
And,
But, I mean, going forward, building new fields, this is what we should be thinking about. Every time we want to put a new field in, whether it's Morgan, a property, or whatever is on the agenda to build a new field, it should be turf. You know, lacrosse teams alone, I mean, we re-turfed, we had to resod the entire, you know, from the 30-yard line,
Yeah.
30-yard line both ways up the middle of the field, because lacrosse is, they're like rototillers on their feet, and it just destroys fields, and they sit around the goal, and it's
Yep.
just one big brown spot up the middle of the field. So that costs, you know, I forget what the cost was to $7,500 to re-turf the field, which we all pitched in to do, but, you know, they never get rest. You know, like I said, this middle modified field is gonna be right back at football on August 4th. You know, the football team will be out in their fields, the high school soccer teams will be back out there. They don't get much rest.
It's gotten a lot better than when we used to play out there.
Yeah, no, it has.
A patch of dirt.
Yeah, yeah.
No, and it's definitely, they're definitely overused, and we definitely have a shortage of fields in town.
You know,
That's
this
without
takes
doubt.
people out of the baseball outfields, you know, the youth soccer programs out of the baseball outfields and gets them out of the turf fields. I mean, I guess-
okay. So we end up with 3 fields that we have today, turfed and more usable is the basic
Yep,
pitch.
yes, sir.
Okay.
And how many were you planning to illuminate? Just one of them?
Well, actually, this modified field over at the high school, the light department put up 2 poles with like 4 street lights for us, and this year we were gonna ask them to put 2 additional ones up. You would never, I don't think, be able to run games there for, you know, youth soccer or at night, because I don't think, but we run football practice there off the 2 lights. It gets, you know, you get shadows, it's dark, but we do it just because we run out of lights in October and November. But the light that Savos said he was, you know, they would light that high school field behind the high school along with alumni's already lit. So you're gonna have 2 full lit turf fields. You know, how they run it as far as on a timer or, you know, however the town works it. As soon as the youth or the high school's off it, they're open for rentals.
Right.
You know what I mean? So
Sure.
the revenues, they're there.
Do you have a sense as to what the annual field upkeep budget is for, I know it's always an issue between Park and Rec and Highway and schools and all that, but do you have a sense as to how much we actually pay to do that?
I know that out of the recreation budget, it's about 24,000 that gets expended on field maintenance supplies. And then Jimmy provides labor out of his department, and it's like $10,000 for some summer kids that come in to help him during the high, you know, use time for these fields. Plus, there's staff in his department, so, you know, there are some
I guess
some
you could
costs that
cobble
can
up
be quantified.
So,
40,000 or so.
well, for,
That's all fields too, that's not just these 3, right?
That's correct.
per hour to use a grass field, it's like $91 an hour. On turf, it's 25. Figuring you gotta reseed or water, whatever you gotta do, fertilize, mow, restripe, everything that goes along with regular grass. With the turf, they play, they go, next team comes. You know, you don't have to schedule lawn mowings, watering. They've looked into, you know, watering turf fields. It doesn't help life, anything like that. So you don't have to put water on the field.
Mark, when you say they have to brush it, is that with equipment we already have, or would we have to get?
We would purchase, or we'd hire the turf company that installs whatever, once a year. It all depends upon what we open the field up to. If we open the field up to X amount of months, then you probably get away with brushing it once a year, you know? And that's just to bring the recycled rubber and the sand back up to make all the grass stick up straight still.
So that's not the piece of equipment Jimmy has currently?
No,
Yeah.
no.
Okay.
Okay, so would that be part of the 1.8? To your point, would that be part of the 1.8 that's quoted, or is that incremental to the 1.8?
No, that is not part of the
Okay.
1.8.
I think there's going to be maintenance to anything that we do, whether it's grass or turf. When we put in a new field, right, you repair the turf or you brush it to bring it forward, there'll be a cost associated with that, while the initial acquisition.
I spoke to some of my counterparts in a few communities that have turf like Acton, and what they said that the benefit that sold their community was that you can extend the time that you can rent these facilities. So you can increase your revenue by the additional hours that you can go into the evening, plus the additional maybe month in the beginning and month in the end, because you don't have to shut them down because of the damp, you know, the soil conditions.
Who presently collects the revenue?
Right now, Park and Rec collects the revenue. So what would happen is they could increase their revenue, and maybe the expense would not be as much, even with the annual
Right, that's what I was saying, right.
Because you're not dealing with the fertilization, you're not dealing with and you can bank that money for future maintenance.
Even though some of these fields are on school property, the Park and Rec gets money
It's
for
a
it?
joint agreement between Park and Rec, the schools, and the highway.
And this is part of why everybody just sort of
Yeah.
backed off on the track.
Because nobody really owns it.
You know,
Is
it's,
it gray, right, gray area?
so, get them all in the same room and get them all to say at the same time.
Well,
And
if they're not that
how it-
interested in promoting it, maybe they won't be that interested in collecting the revenue for it when it comes around. Maybe we
I don't know
can
how the
put
Park
that in
and
a
Rec's not
separate
on board
fund.
promoting it,
Well,
they're just,
yeah,
are
but
they just too
it-
busy? I mean, you're on the board, what's going on with that?
Right.
Okay, I think you've got a good flavor from us of maybe more how all this needs to work and all the people you need to, I know, herding the kittens and get it all together, I know. Hopefully it's been helpful from that standpoint. We appreciate you coming in and telling us about it.
Thank you for your time.
Thank you.
Yeah.
Thank you. We'll see you again, we hope.
Hey, Steve, you want to come up and introduce your guest? Next, we have a presentation from Bartholomew and Company about our trust funds.
This is Joshua Paul and Dory Hewitt from Bartholomew Company. Town's been using Bartholomew since around 2007, right? 2007? I think so. Around 2007.
Okay,
We currently have just over $5 million in town and light department funds and more of a general fund type of account. We have 5.2 billion, 5.2 in trust funds, and we just met with the trust fund commissioners and talked about that. And we have 4.4 million in OPEB dollars. Now, tomorrow, we're going to be doing a contribution tomorrow, 500 plus thousand, so we'll have pretty close to $5 million there. So.
No, I'm
they
sorry,
manage-
Steve,
that's
that's
in
OPEB?
OPEB, yep.
OPEB, okay, thank you.
So they manage, pretty close to $15 million for the town. It's a big chunk of change, and I figured it's time that you guys met them.
Great.
indeed. That's okay, we can share. It's okay.
While Josh is passing those out, I'll talk a little bit about the company.
Thank you.
We are located in Worcester, Mass. We are an independent investment advisory firm, and we trade through Commonwealth Financial, it's our broker-dealer. And the funds for the town of Littleton, anything that we buy or purchase are bought in the town's name. Tax ID number, and help with a third-party custodian for the town for safety reasons. And that is with National Financial, which is a division of Fidelity. We, as a firm, we currently have over 1.2 billion funds under management right now, of which very close to 700,000, not quite, 700 million, I'm sorry, very close to 700 million, are municipal funds. We work with over 170 communities across the state, and we're approaching very close to 80 communities where we're actually managing their funds with the communities. We are both locally and nationally recognized from sources such as Barron's and Register Rep as in the top 100 of independent investment advisors and the top 1,000 of advisors across nationwide across the country, as well as in the top 25 in Massachusetts by these publications. We operate as a team for all of the municipal accounts, and the team is headed up by Thomas Bartholomew, the president and founder of the company. And also under Tom is Joshua Paul as a senior vice president, and Chuck Patterson as senior vice president. Chuck manages the entire municipal team. Josh works with Tom on the financial end of the team. And they also have Alex Bartholomew and Chris Davies work in the investment department of the team. Chuck Patterson, myself, and Michelle Newcomb come out and actually do the service calls and keep Steve up to date on what's happening in the municipal world. Chuck Patterson and myself are both former town and city treasurers. I was the former treasurer for the town of Paxton and the city of Fitchburg. And Chuck formerly worked for the town of Shrewsbury. So we bring in that whole municipal experience from past life. I have about 28 years of experience in the municipal, as a municipal employee in various forms. Did I leave something out that perhaps I should touch on? That's a brief overview of Bartholomew and who you're actually investing the funds through.
Okay, and you said we've been with Littleton since 2007?
Yeah,
about?
it's 2007, I think it was the year before I started as treasurer. Don brought them in to look at the stabilization fund.
Okay, and the first couple of tabs on, in that book, we'll talk a little bit more detail about what it is I just said, but I don't want to spend too much time going into the
Okay.
details of that.
Okay.
I'm going to let Josh come in and talk a little bit about your accounts and what the mandates are.
Good.
So tab 3 is where I jump in. Tab 3 is the annual review documents for the town funds. So that's the funds that Steve mentioned, were the stabilization and the light department dollars. Currently worth $5.2 million. If you go to page 2 of 7 in tab 3, page numbers on the bottom right-hand side, you'll see the portfolio. This is fiscal year to fiscal year. So June 30, 13, you had a portfolio worth just shy of 5.2. June 30, 14, just over 5.2. Again, if you're familiar with where interest rates are, think about what your bank is or isn't paying you. Think about where interest rates are in terms of bond yields. You're not generating a whole lot of income in these portfolios. When I started with Bartholomew and Company 19 years ago, I was looking at communities, and we were looking at selling 5.5% to 6.5% pieces of paper for 30, 60, 90 days. It was great. It was good old days. It wasn't even that long ago. But we're at 25, 50 basis points now. You have to lock your money up for 10 years with the U.S. government just to get 2.5% now. So these portfolios, you'll see the bottom of page 2. June 30, 13, we were getting 1.08 for the current yield. As of June 30, 14, 1.12. So again, better than what the bank's paying you. Our job, our responsibilities for these 180, 170 some odd communities is to invest these dollars. There is a statute within the law that dictates what type of securities we can use, how much risk you can take. The old treasurer's eye chart is what it's called. It's safety, liquidity, yield. Safety is first. These are dollars that you've collected from citizens that you don't really want to go back to and ask for those dollars again. Okay? Liquidity, if the funds are needed because there's some upcoming expense. Stabilization's a big expense that was used from 2008 on when the economy goes down, when you need the money. Typically you need the money when times are tough. So that's when a lot of stabilization dollars were touched. As a community, Littleton, you recently upgraded, you've done very well in terms of budgeting your funds and putting monies away for long-term purposes and not using stabilization as much as some other communities have. So you have dollars that are invested, but again, liquidity is paramount. You have to be able to get to these dollars if you need them, and not at a cost to the community. And the last piece is yield. So as much as we all like to look to see what else is out there to try to make more, yield's the third thing out of three. Yield's important, but there's two other issues that are more important to make sure the dollars are available for your community.
Okay. One of the things we're doing with this segment of the portfolio is we're breaking it out into two separate accounts. The light department has about $3 million of those dollars right now for their rate stabilization fund. They're going to be invested a little bit more aggressive than where they are currently, but still within that framework of that legal list, the statutory list that we have. But there are some equity positions that are allowable for towns to own, and that's kind of where the light department wants to go, earn a little bit more on those dollars.
Not to spend a lot of time, I'm just curious about the light department rate stabilization fund, what that even,
That's their excess dollars that they've built up. They've had some power contracts that they were able to get out of in previous years that those power companies paid them a lot of money to break those
it's
contracts.
still in term, and it's intended though to be long-term, this is long-term stuff. You said even longer than the.
They haven't touched their rate stabilization dollars in quite a few years.
all right.
It's basically they're anticipating that there may be a need in the next 18 months or so to touch some of those dollars.
I live in Groton, and one of the things we've seen over this past winter is the spot rates for natural gas that the utilities have used to generate their power. There were a number of times throughout the year in which those spot rates spiked, and it's not impossible, but it's tough to pass those spike prices on to consumers because you're talking about a very large increase in prices. So we've seen, Groton has seen, using some of that rate stabilization to smooth out the price of the consumers. Again, I don't know if Littleton's the same exact, but that's what I've seen in some communities.
The remaining $2 million is generally made up of the town stabilization dollars, plus a small general fund component. We're going to shift a little bit differently on those two, moving from basically CDs, bank CDs, into a bit more of a fixed income bond portfolio. Still, again, within that legal list that we're allowed to, but basically try to see some extra current income on that.
When you say that the light department wants to do that, who there is making those decisions? Is it SABS? Is it the board?
It came down from the commissioners that they wanted to earn more on those dollars where they could. So we're looking at all their accounts right now. Their rate stabilization dollars, their depreciation account that they have with Bartholomew now, the pension dollars.
Okay. If you go briefly to page 5, that's the quick listing, or that's the short listing of what's currently in that town portfolio. Again, the Massachusetts legal list is very limited in terms of what you can invest in. It's restrictive for a reason. These are dollars that you're not looking to take a lot of risk with because they might be used at some point in the future, whether it's a year out, 2 years out, 3 years out. They're dollars that are supposed to be there for the longer term. You make a level of income on them, but you're not looking to take a ton of risk. The light department is looking to increase the risk they're taking slightly. Again, still using legal list. There are about 25 to 30 names of equities on the legal list. Those will generate between 2.5% and 4% in yield. It's not 100%, but it should help to bump up the overall yield for that portion of the portfolio.
So what would your target be?
For that portfolio, it's about a third of the portfolio in legal list equities. So I imagine, again, I don't know the exact number of what that shifted to, but call it 1.1 to probably high ones, 1.7, 1.8 is my guess. It's not 1 to 3,
Right.
but it'll shift it to closer to the 2% number. The last page of tab 3 is that breakdown that Steve had mentioned in terms of what this account currently represents, what pieces of the portfolio are stabilization, general fund, light depreciation, and light pension. Those two bottom lines are the two that will be moved out over the course of the next month. Okay. Next tab, tab 4, is your OPEB account. So again, I don't know how much or what type of detail you've all received on the OPEB account. Again, it's been something that we've talked about as a company since probably '07, '06.
05.
'05.
Last year, you had a presentation from the actuarial side of the OPEB.
Very long,
Very
yeah,
short,
very good,
yeah,
very
very
good.
short presentation.
So you guys are up to speed on what this
Oh,
whole
yeah.
OPEB is, yeah.
Fascinating, eh?
So this is the investment side, so the dollars that the actuary is looking at, how it's being managed.
Right.
Years ago, I forget if it was Barron's or which publication, but they called it the $3 trillion pothole. Every community is, across the nation is going to face this in one form or another. We have some entities that are districts that are close to fully funded because they have less than a dozen employees. There's a set end in sight for that entity. And so it's a limited, finite, fairly manageable number in terms of how much they have to fund their OPEB obligations. OPEB obligations are very similar to your pension obligations. Pension obligations have been around for how many years? How many years have they pushed out the fully funded date? I don't see OPEB being that much different. These are long-term dollars, 20, 30-year dollars, that is going to take a while for communities to get there. Some communities have been funding their ARC every single year. There's a number that are outside and inside of 128 that have the wherewithal to do that. But there are other communities that are funding what they can, and there are some that haven't even touched funding yet. So there's the full spectrum of what we see out there. As Dory said, we work with nearly 80 communities across the Commonwealth that are funding their OPEB. I'll get into how your account's currently invested, the level of risk you're taking, and how this is materially different than the account we just talked about. You're pretty much going from one end of the spectrum to the other. And then we'll talk about what we see some communities doing out there, hopefully not take much more time than we're supposed to.
Okay.
Okay?
Yep.
So, page 2 of 10, you'll see the values again, June 30, 2013, so end of fiscal year 13. Portfolio was just shy of $3 million. As of June 30, 14, it was worth 4.4. Yield in this portfolio, again, better than what you're getting on the town accounts, but yield's not what we're looking at. We're looking for in this portfolio is total return. Total return is a composition of what you're making for income and the appreciation or depreciation of the portfolio. The idea is, you remember the actuarial presentation that you had? Town's currently using a 4.5% discount rate. The year prior it was 4.25%. So you went from 4.25% to 4.5%. That resulted in a drop in your total obligation or total funding obligation. Every 1% increase or decrease in that discount rate is about a 13 to 15% change in your obligation. So it'd be great if we can just say, let's use 9 and everyone's happy and the number's incredibly low. The problem is that may not be reality. The last few years, 9's been sort of attainable. The mass pension is using 8.5%.
They just
8.25%?
No,
They just
What did it drop it to?
I think down to 8.25.
8.25%, much more reasonable. So
Middlesex is down to 8%.
8%, yeah.
most, CalPERS out in California dropped theirs below 8. A number of entities across the nation have realized that 8.25% to 8.5% is not sustainable. The problem is, if you've been funding these pension dollars forever, and everyone's used to a certain funding pattern, and you all of a sudden say to them, well, let's go from 8.5% to 8%. That's probably more reasonable. But you know what that does to the obligation. You know what that does to the funding. All of a sudden it shoots up. So it's tough on a budgeting process to say, well, let's go from 8.5% to 8%, even though it's more reasonable and the prudent thing to do. What's that do to your funding? So currently the town uses 4.5%. They went from 4.25% to 4.5% because Light Department's fully funding, and the experience of the account's been higher than I don't know if it's higher than what they expected, but the experience of the account is showing that the funds are invested. They're not just in a money market.
At the Light Department, we do 2 separate reports, actuarial reports, and then we combine them to look at the overall town. The Light Department's around 7.5% as a discount rate, because they're meeting their ARC obligation, or just very close to it each year. They're funding it at $250,000 per year. So their obligation's not as much, but they're meeting it. We're behind. We're falling about $2 million behind each year. We have a $4 million obligation to fund each year. Between actual contributions and what we're putting into the fund, we're meeting around $2 million of that. So each year that goes along, even though this fund is growing, and it's good that we're putting money aside, better than some towns, not as good as others, we're just falling further and further behind.
Yeah, there's a new line that, as your actuary, you have to do this every few years. And after the first year, they have a new line, it's called NOO, Net OPEB Obligation. And this is the amount that you haven't funded, and that's the amount that, like I said, that you're falling behind. That number is going to grow if you're not fully funding your ARC, that you're going to see that NOO number go up. And that
So-
will probably one that the rating agencies will be looking at.
Yeah, we're about $14 million behind right now.
We're not happy, no?
Right, so,
So, I mean, it sounds like an insurmountable number, but, you know, if you take little steps, and we have it in
Yeah.
policy that we're doing 10%, but I think we should, you know, think about doing some more to get more money in there. We're getting good returns, so that helps. And the more you can put in there, the bigger the returns, you know, the less down the road we may need to fund. But I think as a goal, within X number of years, we need to start meeting that arc.
to Steve and Dory's point, rating agencies at this point have asked, you have these calls on rating agencies every once in a while when you have a bond issue. They have asked questions about what plans are with OPEB. And it's been, I wouldn't say it's been softball questions, but for the past few years, it's been, what have you done? What's the plan? What have you adopted? Have you adopted, years ago, have you adopted the legislation? It wasn't even funding it, it was just, have you at least considered it? The questions are going to get more and more difficult. You had a rating upgrade recently. At some point in time, rating agencies are going to look at that sleeve equal to you in ratings and look at those individuals or those communities that are funding at a certain level and those that aren't, those that are funding more, and that will become part of the rating process. Again, I don't know how soon. My guess is because we're only a few years in, it might be a few more years, but at some point in time, the level of funding and the level of, ongoing funding and the level of the current account balance is going to play a part in terms of the actual community ratings.
It's
Yeah,
part of
we
it
just-
now, isn't it? I mean, that bond rating, I mean, that's part of it. I mean,
We just had a ratings call yesterday, and Bonnie's going to talk a little bit about that later, but
And
that was a big part of it, the OPEB questions.
Didn't they recently change some things of how OPEB's going to be accounted for on the, whatever balance sheets or whatever?
To put financial
Yeah,
statements,
yeah,
right.
financial
Yeah.
statements, right.
There's been some new Gatsby is the Government Accounting Standards
Yes.
Bureau, and there's been some new Gatsby rulings where you're going to have to take your unfunded liability for your pension, and you're gonna have to put that on your balance sheet.
Okay, right.
Well, you've been funding, so you've got more funding than you have unfunded at this point in time. But the way Gatsby works, they'll let that kind of settle in, and
Yeah,
at some
you
point in
get-
time, they'll
right,
ask you to
right.
put your unfunded liability for your OPEB on that balance sheet also. And in a lot of communities, it's going to put them into a negative.
Right, huge
Their
negative,
assets are
right.
not
Yeah.
going to be able to withstand that. So, and I don't know when that's going to come down. I don't have a crystal ball saying it's going to. We've just seen that,
Yeah.
the way it's, like I said, I've been in this business almost 30 years now, and it follows a progression.
Right.
okay, so you want to talk about how you invest this differently than the others, or what?
Yes,
Was that
so-
your next?
Yeah, absolutely. Page 3 of 10 is just a quick summary on the portfolio. Since the OPEB account was incepted back in November of 2010, you show your total contributions of $3.7 million. The bottom of that row is your time-weighted return. So since inception, you've made 7.2% on the portfolio. Again, better than the discount rate. That is going to help discount rate considerations in the future. A higher funding level will also help your discount rate increase in the future. Okay? I'll actually skip, if I can, for a moment. Let me see where I want to go. Do me a favor, if you're on page 2 of 10 of tab 4 for a moment, what you'll see is, again, this is fiscal year end, top left hand is fiscal year end 2014, and you'll see domestic equity followed by a number of other colors and labels. Domestic equity is just industry parlance for U.S. stocks, so you have about a third of the portfolio in U.S. stocks. Alternatives is an asset class that it used to be years ago, you invest in stocks, bonds, and cash. But what's happened over the past few years is you have stocks that have had a very good run since the bottom in 2009. Bonds have been in a downward trend in interest rates since the early 80s, and cash is paying you nothing. So what you see is market participants on the endowment side, Yale, Harvard, Stanford, have used alternatives for a number of years. Now you see that investment vehicle that was only used by the high net worth and by endowments years ago, now coming to pretty much the mainstream, where you see mutual funds and ETFs that will invest in alternatives. And alternatives, by their very nature, the way that we use them, are risk reducers, they're risk mitigators. We don't want something that's only going to act like the stock market, we don't want something that's only going to act like the bond market, and we don't want to only get paid 0.05% in cash. So we use alternatives as a way to supplement what we're using in the stock and bond side. On the stock side, it's the way to generate returns that are similar to the stock market, but without it being tied purely to the S&P or the international markets, so that if those markets don't do well, it's not as if everything goes down in tandem. Same thing on the bond side. If you have 10-year rates at 2.5, when I started they were at 6, it doesn't take a whole lot of movement of rates back up to wipe out all the interest you're going to make for a couple of years on a bond fund or on a bond. So we use alternatives as a way to balance out what you have in stocks and bonds. Okay, I'll get back to that in a minute if you want. But international equity is just international stocks. Again, this is a global market now. You have other parts of the world that don't have the same valuations as the U.S. now. There are a lot of parts of the market that actually look a lot cheaper than the U.S. markets. Not just on the large cap side, but you have mid cap and small cap and emerging markets now too. So you've got a world that there are investable parts of the world everywhere. And our job is to look everywhere in the investment world out there and figure out what's the best thing to add to your portfolio to generate return. Domestic bond is U.S. bonds. International bond is, again, as the name says, international bonds. Balanced is those funds that are a combination of stocks and bonds, and then a small allocation to cash. The mandate that we've received from the community is an aggressive mandate, generate a good level of return, because these are long-term dollars. As a firm, I guess I should say, as a firm, our aggressive mandate is not nearly the same as a lot of other firms out there. A lot of other firms, you say the word aggressive, and they start at 75% stock and go up. Typically, our aggressive mandate stops at 75%. Again, these are community dollars, whether it's an entity or a water district or a school or a city or town. You don't want to go back and ask for these dollars again. There's a light department south of Boston that was 98% funded. They were forced into the PRIT because they weren't taking enough risk in the eyes of some formula that the state used. The market then fell apart. They went to being 68% funded. That's not what we want to do for our communities. If you don't make all the upside, that's okay. We don't want to give you all the downside too, and it's tough to have one without the other. So the idea is to balance out the risk you're taking, generate returns that are your discount rate, plus an inflation hedge, plus a little bit of a buffer, because you're not only going to have up years. And so that's what we're looking to do with this. Again, very little of this portfolio. If you go to page, starting on page 7, you'll see the individual securities within the portfolio. I don't need to give you individual names, but very little of the OPEB portfolio is going to look like the town portfolio. And for good reason. You're not looking for 1% returns on these dollars. You're looking for at least 4.5%, at least. Okay. Much more involved, more risk, but again, not to the degree where we're holding on tight.
And so the alternative funds, can you just talk about more what's in those? I see some of them are real estate. What are the other kind of things that you're going to find in there?
Absolutely. If you go to the bottom of page 7, start at page 8, you'll see the positions that are in there for the alternatives. Let me take the Neuberger Berman long short, the last one on page 7 as an example. Long short is a description that typically when everyone in the room has a 401k or a 403b or an IRA, some type of retirement plan. Okay. Typically in a retirement plan, the mantra is I'm going to buy low, sell high. That's the way you buy Apple at, split now, so it's different numbers. But let's say you buy Apple at 400 and you want to sell it at 700. So you buy it at 4, you sell it at 7. The $300 in the middle is what you collect for your appreciation. That's your gain. That's buying something, being long something. You buy it low, sell it high. Short is the exact opposite. You sell Apple in September, was it, of 2011 at 700, and you buy it back when it gets to 450 in 2013. Okay, so you're making money by the security going down. And the logic is that you're not doing one or the other, you're doing both. So let's say, for instance, that the S&P has 30% of the portfolio in technology, and you love Apple or Google, but you don't like Research in Motion, the BlackBerry maker. You think one's going to go down, one's going to go up. So what you do is you go long Apple or Google, and you go short BlackBerry. Now, if the entire market goes up, and you're doing it right, we try to find managers that have some experience doing this, the positions that are long will go up more than the ones that work against you on the short, okay? On the other side, if the market goes down, you expect that the lower quality companies will lose money faster than the ones that are higher quality. So you can make money in either kind of market. You don't make as much money in an up market because you have some shorts on the portfolio, but the idea is that you get returns that are fairly similar to the stock market without all the whipsaws of the stock market. There's a fund that if you want to look into, it's called the Market Field Fund. That's one we used in nearly every portfolio up until about 6 months ago. The Market Field Fund we purchased a number of years ago. Their 5-year number, so off the bottom in 09, was 105% return. The S&P was 110, 115. So they're about the same, pretty close. You ask the question, well, why would I buy that? I just buy the S&P. You add year number 6 on, which included 08 when the markets fell apart, and the Market Field Fund made 77% over that 6-year time frame. The S&P made 37%. So the idea is to smooth out the ride. Market Field we don't own any longer. Mainstay bought it, which was a concern for us because once a big company buys a small company, they're going to shout from the rooftops and tell you how good it is. Market Field went from a couple of billion under management to 20-some-odd billion under management. And while that's great for them, we wish them all the best. They're making good fees and they're doing a good job. Well, they had done a good job. The problem is asset bloat. There are certain managers that they'll handle a certain number of assets well, but 2 to 22 billion in a span of a year, year and a half, that's difficult. And we started to see some concerns this year where the numbers were not keeping up with what we expected. So we got rid of the position. But there's one that if you want to look at historical numbers, it's a pretty good example of what some long-short managers can do. So again, if you look at the portfolio, it's 100% stock, but it's not going to act like the stock market. Okay. Makes sense?
Yep, thank you.
Okay.
Anybody else? Good.
Interesting.
Last page of page 4 is again the same report. Again, sorry, it's usually a legal size document, so we did condense it down to fit on.
Tab 4?
Page 8?
Tab
I'm
four,
sorry,
yes.
last page
Right here.
of
I
tab
see,
4.
got it. Yep.
And that's just a breakdown by town, light, and water of your OPEB dollars.
So what message would you have for us on OPEB? Stay the course, be a little more aggressive funding it, be a lot more aggressive funding it? In part of where my question is going is, we've worked awfully hard to get ourselves to the bond rating that we are now. And I think we should jealously guard that. If OPEB is one of the areas that the bond market, if you will, or the rating agency will look strongly at, what should we be doing to position ourselves well the next time they ask harder questions rather than what you call softball questions last time around?
Before Josh jumps in on that, I can take a shot at it. In answer with the S&P question, yes, at some point, they're going to expect you to be closer to the ARC. They're going to be looking for you to be funding the ARC year after year. And whether it, like Josh says, whether it's a year from now, 5 years from now, that's going to be a bigger component of how they come up with the rating. So I think, as a town, that needs to be more of the goal if we want to maintain the status that we're at now. Second piece is on the discount rate. The discount rate is solely based on how close we are to the ARC. That's how the actuary comes up with it. That's why the light department is getting full credit for the earnings that are being generated in the portfolio at that 7.25% that they are, or 7.5%. We're only down. We were at 4.25. As a blended entity, we're up to 4.5. So it's still, here's the 8% level that the actuary looks for as far as the top of the discount rate that they'll go to. And then based on the percentage that you are to the ARC is how they back off of that 8%.
Okay.
So we're funding half of the ARC, we're getting half of the credit, basically.
But again, you're seeing more than just Littleton, Josh. I mean, apparently we're doing okay, but 2 years from now, 3 years from now, what should, in your opinion, what guidance would you give us to, be more aggressive, stay the course in terms of, the rate at which we're trying to fund this thing, even take pain in the operating budget to fund it, to be able to fund some other things in the future. I don't know what the answer is, but what is your sense?
Do you want to add something before I jump in?
Well, you can jump in, but I can talk about a little bit about what the rating agencies, I've had several conversations with rating agencies and with actuaries, and what they're looking for most is a plan. They
Okay.
want it, when they're gonna have the conversations with you, they wanna say, what is your plan and how are you going to get to fully funding this ARC within a time frame? And that time frame ranges between 5 and 10 years, where you
Okay.
are fully funding your ARC on a regular basis. So not that many communities are fully funding their ARC now. There are communities that are, we've witnessed some, but they want to see the plan. So for instance, this will probably be one community in the entire state, but the town of Wellesley passed an override that just fully funds their ARC. I'm not sure how many communities can pass an override to do that, but Wellesley did that.
Right.
We have other communities that have dedicated new sources of income. Alternative energy is big, whether there's wind or solar plants coming in, there's pilot programs. This is new money to the income, and we've had communities that put that whole new money right into this, and that's their plan. This is, we're gonna use the pilot programs, and we're gonna be using that to fund it. We even have one community on the Cape that is looking into funds from the legalized marijuana. If this all comes through, they're hoping that they may encourage that, pharmacies, and take tax dollars from that to be able to put into that. Regulations aren't settled on that, so they're not sure, but this is something that they're looking at. Communities have used the new meals tax, have used hotel tax, the new amounts that you're allowed to tax, and taken that fully dedicated revenue. Some communities have said, we're taking a certain percentage of free cash every year, 10% of free cash, 20% of free cash, we're gonna put that in here. Communities have used it as a line item. Here's our health insurance budget, here's our OPEB budget, and every year they're gonna increase that OPEB budget by 10, 15, 20% in
But
there.
the overall goal that the agencies, the rating agency is looking at,
Is a
I
plan.
regurgitate back what I think I heard, was that within 10 years, or some number of years, we should have a plan to get ourselves to be fully funded over 10 years, 15, I don't know what the number of years is, but over some number of years to be considered, a well-run town by the bond agency.
Correct. Right now, they
You
want to see the
theoretically have
plan.
that, right? I mean, you guys have a ballpark of what you're trying to
I mean, we
do.
have a plan in that we
Not to
increase the
fully
OPEB
fund.
appropriation by 10% annually.
Okay.
So we may need to look at that
Right,
plan.
but that's what I was trying to get to, Paul, because we put in a plan,
Yeah.
but is it rich enough? Is
I
it
understand the
not rich
question, but I
enough?
just wanted to underscore that there has been a plan to boost the number up every year, whether it's
Oh,
matching the
no,
trend line. and-
No, absolutely, but, if what we're doing isn't enough.
Right.
Should we bite the bullet and do something more?
Yeah, and then
Or-
I would have added to your earlier question, what's more important to the long-term trend lines? Is it what we do on the revenue side, or is it what we do on headcount?
It's a combination of health insurance rates increasing over time and headcount. So every body we put in, the actuary has to count that body until they die.
Is there an answer to the question of what's the bigger impact? If you put all this effort into creating more revenue, but you're also adding more bodies, does that outpace it, outstrip it? where is
Oh,
the
sure.
real?
I mean, it's a combination. Every body that we add is an extra expense, whether it's pension dollars or OPEB dollars. And that's the bottom line.
Right.
And to compound that is the 10 to 12% increase in health insurance rates that's factored in forever and ever.
Bonnie, didn't our auditor that came in, didn't he talk about another town, that what they started doing
Yeah,
is every
it's
time they
actually-
hire somebody, they actually put into the cost, they fully fund the
Yes.
OPEB
Fund
for every new
Right,
head
so
count.
it's kind of to stop the bleeding, at least,
Yeah.
you know that you have this outstanding obligation, but at least for the new people coming in,
You
you're
fund
gonna
it.
increase the OPEB appropriation by an amount that's been calculated to fully fund that individual.
We do the study with the actuary every 2 years. So we had just finished one last year, so the next study we're gonna get the average employee cost and work that in. So it'll be
Makes perfect
something,
sense to do
something
that.
more than.
Well, again,
than
it's
what
it's
we've done.
stopping the bleeding and, you know, their
Well,
work.
it's just also the real cost of hiring that person, too.
Oh, absolutely.
Yeah.
But it is,
It is.
okay, so is this something that's being thought of to put into the financial policies?
It's a good
So-
topic for it. I just wrote myself a
Yes,
note.
exactly.
That's what that's what I'm wondering, is
Yeah.
once you codify, then
Yeah.
you've set the hook. But until you codify, whatever the term
Right.
is, it's all well and good to speak about
And it's-
doing it, but it always sort of falls on the deaf ears when it comes budget time.
And especially since the highest number of employees are in the schools, and we don't, in our budget documents, true up the costs, that becomes increasingly, and we've talked about it from time to time, but it becomes increasingly more important, without pointing fingers at anybody, just showing the truth on the page, what, you know, everybody's employees have a set cost to them. It's not that theirs do and somebody else's don't, but we just need to keep those things all on the table at the same time.
Well, is there somebody that can advise us whether we actually have to fully fund, or do we just have to get close to that arc? You know, what's a responsible thing to do in this case?
It's been a moving target over the past few years. As I said, the questions asked and the answers that are expected have changed over the past few years. At this point, the progression is that they want to see what the plan is to get to fully funding. And again, you're funding a particular level and adding to that 10% a year, which may be appropriate, but was that starting point the right level? So if that's $1 million total, and it's 10% more a year, it'll double in 7 years. With compounding, it's not going to be, it's going to be simple, right? 10% per year simple, or 10% on the prior year's value?
Just part of that $1 million. It's just the town's portion of it, that's all it is.
Okay. So that might be the plan that S&P looks at, says, okay, that's a plan, but it's not enough to get you where you need to be. And again, that's something Dora can probably speak to, we can get answers for you. Most communities are looking at it, and again, higher rated communities are looking to fund fairly aggressively and also make sure the funds are invested aggressively. At this point, you can be as aggressive as you want with the investments, but it's not going to be, it's going to be reflected in terms of the total number saved, but it's not going to be reflected in the discount rate until you get closer to fully funding your ARC.
And that has a big impact.
Pensions. Government agencies are never, there's not enough money in the United States to get them fully funded in the pension side. So I guess we're being aggressive on the OPEB side, just so we don't double up and have a disaster on the pension and OPEB sides.
And at some point, pensions are supposed to be fully funded. They keep pushing that fully funded date out.
Never going to happen.
I know, well, it's on the corporate side too. How many companies went from being 80-90% funded, the markets fell apart, they went down to 60 or 70, now they're back to all-time highs again, but they're not at 100. Very few are even close to it.
For Middlesex, we're contributing right now at a schedule that would have the fund fully funded by 2028, I think it is.
Yeah, 2030, yeah, that's what I heard, yeah.
So Middlesex is down a couple of years from the
Yeah,
max.
yeah.
Oh, they took such a bad hit. Yeah. We all took that hit.
Okay, so we'll have a
talk about
topic
this
on
for,
OPEB, we
a couple
could.
weeks.
And indeed, indeed.
Yeah, I mean, I think it's time to review it anyway.
Yeah, I
It
think
was
so.
implemented in 2009, that's when we
Right.
started this funding plan, so
Yeah.
it's been 5 years.
And especially given all the other things going on, it's really it needs to go in that whole mix of all the priorities going forward, so, as always.
Since we don't have
Anything else?
enough copies to go around, is it possible to
Yeah.
email us a copy?
Would you like us to?
How many copies?
How many were we short?
Maybe 2 or something, I don't know.
You guys just had one amongst the three of you?
I just got some writing.
2 amongst
We
the
all
three
each
of
had
us.
one.
One short, I think, there you go.
There's
Now that-
little handwriting in that one, but.
Oh.
It's okay.
Yes, can you
Uh,
show us?
It was,
Mary, you don't really need one, right? So we're good, I
it
think we're
was
good.
only you, Steve, they just, no.
Don't read anything into
Oh,
that.
again. Blame Steve.
I noticed the lettering on your name tag was different, so I figured that was okay, so sorry.
All right, anybody else have any questions? This was very, very informative. Thanks, Steve, for arranging it, and thank you for coming in and spending part of your evening with us. Appreciate that.
Very enlightening.
Thank you.
Scary, but enlightening.
The rest of the binder, I believe it was a client list and then the Mass General laws. The rest of it.
Yep, great.
Yeah, great.
All right.
Thank you so much.
you.
Thank you for having us.
Thank you.
Information.
Okay.
So Betsy, within this topic here, who would be developing this plan?
Well, I mean, there already is a plan, so it's a matter of reviewing it as we go through the budget process and the policies in terms of what we want to
It's a
do.
part of our financial guidelines.
Well, and again, our part of it is really how much gets funded, and then how it gets invested and all these other things, it's obviously it's Steve and it's a lot of other people, but.
Well, 5 years ago, the issue was, are you doing anything? And
Right.
nobody around us was really doing anything, so we started a plan, kind of in a, vacuum of, let's try and start this. So we looked at it, we got an
Bonnie,
amount.
excuse me, sorry.
We did bring more, they were. We have, I want to slide you,
Thank you.
and then one more, just.
I think we're all set.
We're all
I
set.
think we're good.
Okay.
Bonnie, you want one? There we go. Okay, thank you.
Thank you.
Thanks.
You took the one with all the answers.
You didn't get the answer sheet.
42.
So we did just we started with a number that we could work in and figured we're gonna add 10% to that every year, and we've been consistent with it. And as additional funding has become available, we've made additional appropriations beyond that, one-time revenue, so.
Do we have an idea of what it would take to actually get to fully funded? You mentioned 10%, but we're still short.
We need to be putting in, $2 million a year, and we're putting in $665,000 this year.
Were you here for the actuary, you missed that?
I was here, that was
Here for
very,
That's
that
right.
was really eye-opening.
It was, yeah.
Wow.
So, should probably come back again after they do the 2-year cycle.
I'm just remembering what was in that.
No, it was a lot, yeah,
Lots to
right.
swallow, but,
Bonnie's got it.
yeah, definitely a lot of data, but.
So I'm sorry.
Well, it's the topic we talk about in July and August, but we gotta remember to talk about it in November and May.
Well, it's just always got to be there. Every discussion that comes up, do we have money for this, do we have money for that? It's always,
Exactly.
it's always instead of what?
Yeah, I mean, it's one of those things you appropriate, you don't see something for it other than, maybe a reduction in your.
Well, it's sort of like funding your 401K.
Right.
Do you do that, or do you put an extra CD player in your new fancy car, right?
Yep.
CD
Yeah,
player.
me too.
Okay,
All right,
Reserve
reserve
fund.
fund transfer.
please.
I hope you all got the email that I sent out this afternoon.
Yep.
I got your request last night. I asked Tom to start, seeing if he could drill down a little bit further. Just as some history, Tom created that report that I emailed you based on a finance committee request a number of years ago.
Okay.
So having him drill down is just, updating the request from previous years. So he was able to provide a little bit more specific data. In addition to that, I provided you some information on the other not general counsel costs. So Tom gave a little summary on each case that he had listed and what it really relates to, because I said, they're not going to know what 184A road is. You might not, I don't on all of these, so. He did provide a little summary on each one of those. And then I'll just jump to the next one really quickly, but Tom Harrington is general counsel. And he covers pretty much all land use issues, all general municipal issues, anything that has to do with town meetings or lawsuits or any general municipal kind of question that might come up. So he's the one that's used most heavily. We do have separate counsel for labor counsel, and we use Copeland and Page. Copeland and Page is very good. They have a specialized labor group. We bid that out a few years ago and have had some success in this last bargaining round. with our 4 town units. So they deal with all of the collective bargaining and any contractual issues or grievances or anything that might come up with relation to that, just those 4 bargaining units. Aside from that, we have John Dolan, or Jack Dolan, who is HR counsel. We have a deal with him where it's a fixed fee amount, it's $20,000, and it's unlimited consultation for human resource policies, payroll, FLSA processing issues, all non-union contracts, and bylaw employee issues. And we use the heck out of that contract. We did not have a lot of personnel policies in place. I know.
Yeah, the Personnel Board uses him a lot.
A lot.
Yep.
So we try and get our money's worth out of that. That actually was reduced when John was with Kopelman and Page. We had the same arrangement, but it was $25,000 a year. So he went out and hung his own placard out, and he gave us a little break when he left. And then we have 2 other attorneys that we use, Coppola and Coppola, for tax title cases. So any land issues that we're taking or for non-payment of taxes. And Ken Gurge, who does ATV or appellate tax board cases. Mr. Gurge is very well versed in ATV cases. He used to work for the ATV, and he knows everything that needs to be done. And often with ATV cases, it's not, do you want to lose or do you want to win? It's how much do you want to lose by? When you're dealing with large commercial properties like IBM, when they file abatements, or Market Basket, these are large tax dollars that we need to have specialized counsel for. And they're relatively low expenditures for those types of cases. And I also provided you with the information regarding the use of town council that's adopted by the Board of Selectmen. And it's, Keith is the gatekeeper to access to town council. If there's a question, it's always brought to the Board of Selectmen. If there's, if Keith's not sure that it should be appropriate, to access town council, he'll bring it to a board meeting and have the board give him his opinion. But everything's got to be cleared through Keith. That changed a few years ago. It used to be kind of a little bit more of a free-for-all back in like 2007. So they really firmed up the policies, and town council will not even, take a question from somebody without clearing it with Keith first. So aside from those issues, the request.
Well, can I?
Go ahead.
On the legals, I see you say this is a format that was used before. I don't know how far back it was, but I remember it as a helpful format was one that would assign dollar amounts by case, and it was more detailed on specific cases. And I know we structure things so that there's going to be an anticipated reserve fund transfer request for legal, and that's fine. And so this is not only expected, I agree with that approach, but I think it'd just be helpful to know where the actual, I'm looking at a list of 15 things, there's no idea, it's not evident anyways, what was expensive, what wasn't, where were the dollars getting spent. We're not going to recreate that now. I don't know, you indicated you were going to bring the bills, but I guess this was in lieu of those.
Yeah, the bills.
So I don't know, it's not really, doesn't paint a picture for me as to where the money was getting spent, but for instance, there was a number of late winter, spring executive sessions. Is that stuff still, has that been released from executive session, or is that still all executive session? I know council was in there pretty much every week for a while.
I think that there are some minutes that are going to be released in the next meeting. I think
Is that all accounted, that activity all accounted for in here somewhere?
That would be, I believe, under general counsel. Just town council, the line that says town council, which is kind of the catch-all for items that aren't classified elsewhere, if there's a case that doesn't arise to a particular.
Okay.
That's where the big bucks are, too.
Right,
Yeah,
so
yeah,
that's
well, it is,
it's
town meeting, it's,
Yeah, all that.
nice, but not really
So what did we
helpful.
fund for 15 for a budget?
We have 15 funded at 175, which is the same level, but in 16, I have pushed it to 200,000 in order to try and address it.
And just out of curiosity, what does the school, the only other big legal bill that we have as taxpayers when we fund the schools would be the schools. Do you have a ballpark as to just curious what the total legal nut is.
Don't schools have their own legal fees?
They do, they have
They
their
do.
own counsel.
Yeah.
Yeah, but we pay it, I mean, it's, the
We
town
pay it,
pays
but
for it, so.
It's in their budget.
It's in their budget.
Yeah.
It's in their budget. I could look that up. It's
It's
something
just,
that I could.
you don't have it ballpark. Okay, I just didn't know whether it was somewhat similar or a half or more. Okay,
Maybe, right.
I can send it. I can
okay,
email it out.
that's all right.
Does school use a separate
Labor Council.
labor council?
Yep.
Yes.
I thought they did.
Always have it.
So they have a general council and a labor
They have,
council?
yeah, their own team. It's not the same. It's not- They have two firms. That's like that.
Okay.
We didn't- well, we don't get to look at that line item, do we?
On the schools?
You can look at the actual expenditures, that
No,
stuff, so.
I can run the report.
Okay.
Since we have this one.
I can just jump on my end of the year report. I'll find that. Be listed.
Okay, so that's town council. Are there, I mean, I can, if you have suggestions on the report that you want Tom to,
Well, the
this would
suggestions
be-
are to see the breakdown. Basically, I mean, this is asking us to sign a blank check. I mean, basically, we can't see what's being spent for what. I mean, that's the bottom line of it, right? So we're being asked to transfer money, we don't really know what we're approving. I mean, it's already been spent, and it's there, we understand all that. But that, from our standpoint, that's what it is. It's like,
okay.
Well-
I mean, it's a change of format. If we want to change, this is how it's been done in the past, I have no problem changing it.
Wasn't-
Well, at one point in the past, and I don't know how far back, my memory unfortunately spans way back, we used to get, when these reserve fund transfer requests for legal counsel would come in, it would be, here's the cases that are driving it, here's the dollar amounts associated with those cases or uses. And that's what I was personally expecting. Now, if that hadn't been the norm for the past couple of years, I hadn't noticed that, but,
Yeah, it hasn't been since I've been.
yeah, well,
When I first came, there was no report, so I asked him to create.
And you might
it
have
used to
seen-
happen and then they disappeared and maybe they can reappear.
Well, maybe you've got a different list as a selectman.
Could well be, but I know that
Because
FinCom.
some of it was.
I don't remember ever seeing
No,
it.
I don't remember
FinCom
ever
side.
seeing that level of detail. And the reasons that we were historically given was that, a lot of it was in executive session and the minutes hadn't been released. So it, in effect, it wasn't public information.
Well, what I remember specifically are just reports right from council, and it would say, here's the cases and here's the dollar amounts. It wouldn't disclose anything that would prejudice a executive session account, and it was specific to the reserve fund transfer request. So when that was, I would, whether the FinCom got it or not, I assume they would, because it was, but it's, whatever. Just going forward, it's the same, other folks come in and ask for reserve fund transfer requests, we just look for.
Detail,
Yeah,
absolutely.
detail, that's
Yeah,
fine.
no, we should. If it's available and legally available, then we
Right.
should have it. But, I just, in the back of my mind, vaguely remember some problems with some of the numbers, so.
but even on this, I mean, it could be that some of that town council number is, but even if we had the dollars on the other ones, it would give you an indication of, is it
Relative
10%
size.
or 90%? What are we talking about? That, so again,
But isn't this spreadsheet, doesn't that tell us the dollars?
Yes. But I think
But
what
not-
the question is that one of the line items is town council, which is kind of the catch-all for the items that aren't.
Right.
Right.
And that, that's the largest line in the, so to see more breakout within that.
But we wouldn't normally ever have that breakout, the lawyer would, right? We wouldn't have that. He just bills us monthly. We don't have that, we would never have that breakout, right?
Oh,
Sure it is, it's in the bill, of course it is.
Well, it's in the
I don't
bill,
know.
it's in the bill individually as the coming in monthly, right? It's not.
Not any different than buying seed for the park and rec department or
Right,
buying
but Paul,
books for the school.
somebody had to manually keep track of that every
Well,
month. It's,
That's called
Well-
accounting, yeah.
well, there's an account, and there's a $150,000 budget for legal expenses, and the bills gets charged there. To do it by case,
Well, we're justifying an increase to a $264,000 line item. I guess I feel that we should be getting an accounting of that, that's all.
Well,
I don't question any of these expenses here, I just don't think it's unreasonable to
Yeah.
have the backup for it.
I'm just saying that it's probably residing in the lawyers, the only
It's
ones
the-
gonna.
yeah, the
Yeah, they're only
The
ones
lawyers
gonna
can give it to
know.
us. They can provide it.
Right.
It's okay. All right, so do we need to vote on these individually? You want to go through them all and then do them all at once?
I mean, it's totally up to you.
160,000
Keep going.
lawyering.
So the next one is for wastewater stormwater expenses. It should say 12,000, I don't know, I made a typo here, but it's not 13,000, it's 12,000. The current budget is 65,000, so with this transfer, the total expenses for 14 would be at 78,000. Last year, they were about at almost 70,000. We had some unexpected expenses this year. This is kind of a tough account to budget for because it's managed by the light department. So they do all of the actual work related with this wastewater and stormwater stuff. We had some DEP reports that needed to be done and testing that needed to be done on the stormwater side. DEP said, if you don't do it, then we're gonna fine you for it, and then we're gonna do it anyway. So you either pay one way or another. So the water department arranged for the testing which needed to be done. I do think that this is an account that's just gonna need to be bumped up, probably at that $78,000 level going forward, because these tests just keep to be appearing.
So you're looking for 12,000 though, not 13?
12.
Okay.
12,000. Veterans benefits, I alluded to this a few weeks ago. We have all of the final settlement from his cases, and he needs a transfer of $6,316.80. At the current budget of $67,000, that will put the total expenditures at $73,316.18. Last year, they were $36,000 and change. So this is, it's a very large increase, but there have been a number of increases in both the number of cases and the types of benefits that are available. There is a corresponding increase on the cherry sheet in the revenue in the following year for this. We do get 75% of this back, whatever we spent. So there is some relief in that area. And I have, checked to see that we're getting that payout consistently.
This thing is just totally ballooned in
Yeah, it
terms of
really
clients. What was it, 4 years ago, when I stopped being the veterans agent, I think?
Yeah.
And up until that point, it was $17,000
Well,
a year.
a couple thousand extra.
And then that last year that I was there, it went up 2,000 or 3,000. But the caseload just became, a year later, just ballooned, so.
What's causing that to happen?
The economy. We don't have any more veterans than we have, well, we have
few
more
more.
because we have wars going on. But when the economy went down, more people lost their jobs, and all of a sudden they've got to take advantage of whatever I have coming in. And I do have veterans benefits, so without a job and no money coming in, I now qualify to get something in terms of veterans benefits, and so they're actually coming in and doing that. Before, a guy didn't delve into that stuff. In fact, he wouldn't even qualify because his income was too high. But with no income coming in, all of a sudden you qualify.
Yeah.
And the last one is just a very small one for the Finance Committee, for the wages.
Oh, I want to know,
Honor Brian.
who spent all that money? Who was the chairman?
That was the chair.
All these international trips, our secretary is
So we did correct that for this fiscal year. We increased the budget, adjusted it to accommodate for the minutes and everything, so.
In our own defense, we used to get $5,000 and we
when you get
cut it
nothing.
ourselves.
So that takes care of the reserve fund transfer requests. So again, there's four. There's 55,000 for labor, 12,000 for wastewater and stormwater, 6,316.80 for veterans benefits, and 104 for the finance committee. So if all of these are approved, your reserve fund would close out with a balance of $30,487.
They're reflecting in 12,000 or 13,000 for up here? See, this is just a typo,
It's 12.
just to make sure.
Yep, 12.
Okay. So how do we do this? Do I have to say something, or somebody's going to say it?
So,
I'm
can we
gonna
make a
make
motion? So, we make a motion to move the reserve fund transfer request
As presented.
as presented, the 4 items as brought forward.
What's the dollar amount on that again?
some of this thing, so it's 55,000, 12,000, $6,316.80, and $104.
Which comes to?
Oh, I don't have my,
Ding, ding.
42080 plus 67,000.
Don't we normally have to sign something to reserve
right.
fund
That's
transfer?
what I was thinking of too.
you don't actually have to sign it, you have to vote it.
So what are we signing with the other ones?
It's just the form that's been used, and I'm like, this is kind of, you know, I looked it up, I'm like, there's no, like, legal requirement for you to do this. It's the vote that's being
Right,
voted.
right.
So it's a documented vote.
It's a document that gets put away, and then,
All of a sudden Diane will be coming looking for it like a year from now. And
well,
where is that in the
what I
minutes?
do is when I book the journal entries, I use your minutes. And-
Well, our motion should at least have the
Like that.
total amount.
$73,420.80.
I
You got
agree with
Fred?
that. I just did it too.
Got that,
The same
Brian?
number.
Okay,
We have
So-
a motion.
Sure, we get it.
second, anybody?
Second.
All those in favor?
Aye.
Did you get that dollar amount?
$73,420.80.
We can break down the 4 individual line items. You've got those?
I will.
Sure.
Okay.
Everybody did the same thing.
The next one is year-end transfers.
Okay.
Year-end transfers are a little bit different than reserve fund transfers. These can be accommodated within the last 2 months of the fiscal year and the first 15 days of the following. And you're allowed to transfer between line items an amount not to exceed 3% of the operating budget for that particular line item, or 5,000, whatever is greater. So usually we'll use this for small transfers or items that departments can accommodate within their own budget. So for this year, there's a small one for gasoline in the amount of $5,000. We should have really adjusted this budget last year, but we didn't. I did correct it in the fiscal 2015 budget because we had incorporated the Council on Aging bans into the town budget rather than through the MARC budget. The fire department had some collective bargaining allowances for uniforms and cell phone reimbursements.
So you
that-
built that, you budgeted that into salaries?
Well, what they used to do is the way the contracts read,
Would they just get a flat amount?
they get it,
In their check?
so we
Just
put it in
get
payroll.
$500
So
bucks?
we budget it in payroll because they would take it in payroll, and we would tax them on it.
So they didn't have to even submit anything as far as if they even spent it, they just,
No.
here's the $500 and off
That's
you
the
go.
way the contract language was written. Through some management practices and some changes in the last few years, once we started taxing it, that kind of changed.
Oh, yeah, that,
Yeah,
yeah.
because when I first came, and Ann and I were first looking at this, it was just, they would just get the money cash.
Yeah.
Like, and I was like, you can't do that, so we started taxing it, and applying it to the, the payroll process. So now people are applying for reimbursement more, and which is the way that we would prefer them to do it. You buy a we want the uniforms to be kept up, we want, so they purchase the items and then they submit for
So
reimbursement.
each year they get a whatever allowable
Right.
amount?
Right. So, because these items were budgeted in wages, and they actually used them the way that we wanted to, it hit the expense line item. So he just needs to do a transfer between the wages to the expense lines so that he can accommodate.
So what does it look like in the 15 budget? Do we have the same issue in the 15 budget?
We actually talked about that last week, and I said we should do a transfer in the fall and just shift that money out
Right,
of,
so we don't have to
Right.
have the year-end transfer,
Right.
okay. Okay.
and this is a good thing. I mean, they're using it
Yeah, no,
in a way that we would prefer that they use
Oh, yeah,
it, so.
definitely.
So again, it's within the fire department budget, it's managed. And then the way that I'm funding the gasoline is we had a better year with the general insurance than last year. Last year, we were at about $340,000 for general insurance expense. And this year, our actual expenses are about $300,000 because the claims are better. So I can afford to transfer the $5,000 up to the gasoline account. Just on a side note, the fire department wages, I know that, this was really the first full year with the new staffing and the budgeting, and there were some concerns about overtime. Even despite the fact that they had a lot of health issues with, some injuries in the department, and having the staffing that the way that they did, they had a swing person that was able to be shifted around as needed. They're turning back about $150,000 in wages. So they have, Scott's been very sensitive about not blowing through overtime. And, we've had insurance for, other issues, so, it was a good management.
Thank you for bringing that up too and highlighting that. Those are things that get lost normally, I think.
Yeah.
Yep.
And Scott provided just some information on the expenses that he had shifted, just to show you how it broke down. It was between the cell phones and the allowances for uniforms. So really, I would just need you to vote on these transfers, the year-end transfers as presented, totaling $20,393 between departments.
Do you want to make a motion, please?
Move that we approve the year-end transfers as presented for a total of $20,393.
Second.
You said 20,000, not 200,000, right?
20,000.
Okay, just want to make sure I heard it right.
It was up to 600.
Yeah, I made that mistake one time today, so I thought I did it again.
Okay. Is there a second?
Yeah, second.
All right. Any further comment? All those in favor?
Aye.
Okay. The next one is financial policies update. I know most of you, I don't know if all of you were there, I couldn't see from the front row. But I know you were there at the meeting last night, and this is just kind of a reminder and kind of gathering up the items that have been discussed in the past, both with staff and with other board members, about things that might need to be revisited or clarified or addressed within the financial policies that we have now, and we can add OPEB to that.
I was just gonna say that, we had OPEB, our plan
Add
for OPEB.
OPEB. But, some of the things that have been discussed most recently is the funding of excluded debt, the funding and use of capital stabilization fund. We have some general language in there, but I know that there was some indication about firming that up. Use of unallocated cell tower funds, that's one that gets thrown around a lot. So, I didn't know if there was some consideration to be incorporated into the financial policies. Community Preservation Act funds, both the expenditure and state matching fund component, contributing additional dollars in there. That might be something that could be looked at as funding priority or, long-term planning for these types of projects. I think, there's a lot of discussion on how the community preservation funds get spent. Do they get spent all in one year? Should we accumulate some for some X number of acreage purchase in X number of years, or?
Is there a plan?
There isn't.
There isn't.
There is not.
So that's-
So,
Oversight, integrating that into the whole greater
Right.
budget and capital
Right.
picture is what we
right.
kind of woke up to this year, I think.
Started
Yeah.
moving away in that direction.
I did provide some information, again, regarding our bond rating upgrade that happened this year. I would also provide, we had a really interesting conversation, and Steve was present for this on Monday. We had a conference call with Standard & Poor's, Victor Medeiros, who's actually been reviewing our financials for at least 10 to 15 years, when you look back through the documentation. We met with Scott Edwards from the Water Department and other Water Department staffs, Keith Bergman, just to give an update on the economic condition, the financials, and the Water Department issues as they relate to this debt issue that they're looking for their treatment facility, or their well facility, the well.
Yeah, water treatment.
So, after going through everything, and he wanted to reiterate or really point out what makes us a AAA community. And they said the fact that we have a high liquidity and strong reserves, the fact that our policies are embedded and that we follow them, we adhere to them every year, and the fact that we have a relatively good economic outlook in this area with the highway infrastructure system and everything else. So, we kind of went through the whole thing, and then he said, kind of as an aside at the end, he remembered back in 2005 when he had to do a negative outlook. Yeah, I put it in there. And I wasn't here in 2005, it came in 2006, and I was insulted when they maintained the negative outlook in 2006. So I just started, and I was like, no. So I wanted to pull that documentation together. And he said, looking at this community now compared to then, he said, this is a completely rehabilitated balance sheet. He said, you're in such a much better position. We had concerns about lowering the bond rating back in 2005. They hadn't lowered the rating, but they had warned that that would be the next step if there were corrective action taken. So back in 2006 and in 2007, that was when the first draft of the financial policies were put out and adopted. And I think in 2007 is when they removed the negative outlook. And then we kind of built up our rating system since then. So it's not often, I think, you get feedback like that from Standard & Poor's, and particularly from somebody that has been looking at us for, I think since 2002 we saw his name on a lot of the rating documents. So, it was a good thing. But again, the things that they really wanted to point out was liquidity, both by way of undesignated fund balance and stabilization fund, and policies and the economic component. So the selectmen did actually agree last night that it's, obviously it's time to renew them again, renew the policy. And
Make sure that we don't backslide on it, right?
You
Absolutely.
provided also a copy of the financial management policy.
Yeah, the existing one.
This is the current.
Yes. I did also, in looking at this, when I printed it, I know that it was approved by the Board of Selectmen on October 21st. We have that vote. I looked through all the Finance Committee votes, and I have a meeting from September 24th or 26th where it was reviewed, but there's no, I can't find a vote.
We did vote. I think it was after the selectmen voted, so
Okay.
it might be in that period of time where there's some missing minutes,
Okay.
but
Pretty sure we did.
we definitely did
Okay.
vote. Yeah.
I just couldn't find, I would like to put the date on it, but I
Yeah.
can't. In case you're wondering what it's about that.
So I'll check my records and see if I know when that was, but.
Okay.
So for that, we just need to continue to have the team meet, right? That's been working on policies. It's really not a starting something new or anything like that. It's just a continuation of having the meeting, get back to it again and update as appropriate, given this new.
You're now.
You're now
All
in
right.
charge.
In fact, the selectmen last night charged Betsy with scheduling things, so that's
And they did name Paula Bella. as the
joined Jim
one.
Cara.
Paul and Jim Carr. And then
Mike Fontenot.
Mike from the school committee, right? So we'll work on getting some of those meetings going, I guess. Summer's tough.
Maybe we should solicit again ideas you have beyond what Bonnie printed, when we mentioned here, other topics that came up, at least for reviewing the OPEB. We talked about CPC, we talked about whether it's reflected in the policies or just is talked about in that process, that going into the town meeting with the deficit budget topic. And
You had a draft for that?
what's the, you have a draft for that? Okay. And the other item that I know appears in other towns, I think we've talked about this before too, is kind of a preamble, just a layout of the process and what different people's roles are in the budget process. I'm not looking to break any new ground there, but just kind of avoid any confusion.
There's a section that we have in draft form that talks about the budget calendar and how it's a joint responsibility.
And whose roles and.
One of the other things I added is.
It just was a specific point, that interrupted me for a moment, Steve, in the spring where it came up, that it was a little awkward where we were voting on something before the selectmen did, and they were a little irritated, believe me, I heard about it from their chair. And it was just, I think it was something that could have been avoided if we were on the same page about, are we voting on your recommendation, voting on our recommendation, et cetera, that sort of thing. But you say you've got some sort of draft language?
Yeah, we pulled
Yeah,
things
there's
from
there's
the
some
group.
things with.
There's tons of
the
boilerplate
budget
out there on
calendar.
that.
one of the things I put up front in the draft document that we'll be seeing is kind of like goals of the town. You know, just 5 or 6 different bullet points that, I mean, they're totally up for discussion, it's just things I put out there, like maintain the AAA rating. Should be a goal of the town. Reach, you know, the funding of the ARC for the OPEB funds by whatever, you know, just certain things.
So you're working on a document as part of the financial policies, or just as a general for the department in the town?
As the
Policies.
update
For
for
the
the
policies.
policy.
So besides these board members we talked about, who else is on this committee from, are both of you on the, both of you? Okay.
And currently, our representation is
Chair and vice chair.
chair and vice chair.
Well, that's how we originally set it up, so,
Okay.
yeah, Chris and Don.
Okay, because Chris was vice chair.
Right.
I'd like to stay on it if that's possible. Enjoy the meetings, so.
Well, it's called to order by the finance committee. Your call, something like that, so. Certainly, with our vote, you can sit in anyway,
I was
right?
gonna say, it's certainly an open meeting at any rate, we'd be happy to have you come and see and do it. I don't know, I mean,
Is it even documented
I know,
anywhere?
yeah,
that's what
It was
I'm
sort of an ad hoc.
It's been memorialized, it was gonna be 2 selectmen, 2 finance committee, and finance committee member, and what we had decided, at least initially 2 years ago, was it was chair and vice chair of the finance committee. And as I say, the meetings are open, it's a working group for a reason, it's not, you know, a formal session facing an audience, it's more sitting around a conference table, so.
so you're still on, thank you very much.
Great.
Okay. Okay,
Yeah,
anything else, Bonnie, that you want
Just
to?
a quick, just a update for, I can give you some preliminary verbal on 14. I'm almost closed. I had to wait for tonight's votes so I can post my last entries. I am way ahead of schedule compared to normally, I don't know why. I do have the auditor scheduled to come out in August, so that we should get an earlier report. That's probably why I'm closed right there. But it does look like fiscal 14 is going to close without any issues. There are no revenue deficits at this point. Again, I need to finalize all of my entries, but we have a small snow and ice deficit, relatively small comparative to other years. It's about $150,000 in deficit. We had budgeted for a $450,000 deficit, so it's within what we had planned on. So I will have a draft balance sheet to you probably in about 2 days, which is crazy. For fiscal 2015, we are in balance with the final cherry sheets. We did pick up about $72,000 in additional net state aid, both on the town side and the school side, between Chapter 70, general municipal aid, and then, you know, backing off the assessments that have changed. So we picked up about $16,000 in school state aid and about $56,000 in town. I also have been tracking the local receipts, and excise has come in very strong this year. We budgeted $1 million, it came in at about $1.3 million. I had pushed it for this year's projection for fiscal 15, but we had it set at $1 million last year, and it just, everybody must have bought new cars. So, yay for us. So I'm gonna close the gap remaining for 15. I had already pushed it up, but I'm still comfortable pushing it up a little bit more to close that remaining gap. So we are essentially balanced for 2015. The 16 prognosis, I just rolled things over, put in some general assumptions based on some conversations that we've had in the past and looking at the actual receipts. I pushed local receipts another 1% just to start things off. Level funded on state aid. We did get an increase this year, but you know there's no guarantees going forward. So 0% increase on both the town and the municipal state aid right now. New growth, I have programmed for $750,000 in 16. That's because of the hotel coming on at that time frame, and some of the other housing starts that'll be coming in at that point, like 15 Great Road. I have 500,000 in 17 and 200,000 in 18 through 20.
Any more input on the 40B when we're likely to start seeing inhabitants up there?
They are doing the wastewater facility, treatment facility now, so that needs to be in place before they can start the other things, but that is well underway. So I would think.
Just the impact of the schools is
Yeah.
really the only concern that I would have is that
See the other side.
an extra 20 or extra 50 kids show up all of a sudden.
Maybe that'll be delayed by a year and a half, so.
Okay.
So on the expense side, I have for fiscal 16, a 3.25% growth in town department budgets, which is including all of the steps due, but no COLAs. So we don't have any COLA factor. All of the town bargaining unit contracts expire June of 15. So for 16, if there is a COLA, will need to be factored in here. A 0% increase in operating expenses with the following exceptions: $30,000 increase in veterans benefits and a $25,000 increase in legal expense, just because of the activity that we've discussed before. So if you back those things out, it would be about a 2.5% increase in the town budgets, department budgets. The school, I increased the appropriation by almost 3%, or $500,000, over fiscal 15, based on the conversations that we had last year about using circuit breaker funds, and we had all kind of said, if we do it this way, we need to fund this at least starting at $500,000 last year, so that's what I put in. We're projecting about 11.5% increase in fringe or employee benefits for both town and school employees, so that's primarily health insurance and retirement expense.
Is there any great science behind how you arrived at that number?
It's an average.
Average of?
Yes, it's an average.
Last
like
couple of years?
Yeah, 5-year average.
No early new numbers that would suggest what any trend lines there?
No, we're not going to get anything from Maya until like March, really. March is about the earliest that we get it.
Even in terms of what other towns are doing, I guess everybody's on the same calendar essentially.
The general recommendation from most of the auditors is anywhere between 10 and 15%.
Yeah.
So I hate to push to 15 if I don't have enough evidence right now. In prior years we did, because we had a lot of enrollment increase, and that seems to have kind of been leveling off a little bit. So I'm pretty comfortable with the 11.
So what do you get in March from Maya? You get the new rates in March?
Yeah.
And then,
April's open enrollment.
April's open enrollment, our new rates start June, not July.
Bonnie, are you in contact with the school department? Do they know what you're putting in your projections here, just in terms of your?
Yeah, I already briefed Steve Mark and gave him a copy and said, he was in the room when we had this conversation last year, but there's no, indication of whether it meets their needs, doesn't meet their needs.
But just so they're aware, so everybody's working on the same thing.
Yeah. There is a 10% reduction in debt service, which we captured that and shifted it to the capital fund. It's primarily because of a reduction, a one-year reduction in short-term interest expense. We had paid down the band for the track. That will be done this year. So the track will be able to rescind the debt authorization for that. And also the Russell Street School and the sewer, that's all done too? Yeah. But next year we'll have the roadway debt. So it's going to be down for 1 year, and then it'll be up, back to normal levels in the following year. So to accommodate that 1-year dip, we don't let debt service roll to the operating budget.
so we'll have a larger amount to contribute to capital?
Yes.
Or OPEB could.
Or other
It
ones.
looks like our capital has been pretty robust. We haven't been saying no to too many people on capital requests lately.
Oh, we say no to a lot.
Well,
Yeah, well, the thing you want to watch out for
We
is
said no to a lot, but we've been funding a lot more over the last 2 or 3 years than we ever had.
right,
Yes.
that should have been my point, yeah.
Right, and
Yep.
the thing that we did not fund is the buildings.
Right.
I mean, we really, it was a full 100 and something thousand, and they were looking for significantly more than that, so we want to make sure we don't lose that.
And is this where that's captured, that assumption?
It just pushes it to be, it's an available resource for capital, or
Right.
one-time expenses.
Including what Fred had referenced.
How much is it roughly?
I think in total it's $1.8 million between the debt service and the undesignated fund balance.
So $1.8 million as opposed to what we,
Like
almost
$1.4 million.
$1.3 million, $1.4 million,
Yeah.
right? So 400,000 higher than normal?
Yeah, so it's a,
So the.
but the year after that, it'll go down to like $1.5 million.
Consider it.
We'll go back to normal,
Right.
right, and we'll have that one,
Right.
I mean, maybe a good opportunity to drop in OPEB.
Right,
We
it's-
should still be able to fund capital equipment and capital maintenance about the same level that we've done last year.
Yes, we will.
And still have that little bump that you can put something,
Right.
either there or somewhere else,
It will be available.
like we did the $900,000 gift.
Yeah,
Got us started with OPEB.
right.
Okay.
So under those assumptions, the structural deficit in 16 starts at about 400,000, which is, you know, it's a modest deficit, but, you know, I've seen it worse, starting off.
2 million before.
Yeah, so, you know, I'm cautiously optimistic. But, you know, when you go out to fiscal '20, it's 2.9 million. So,
Well, that raises, another point we talked about too, is we're great about projecting our structural deficit, but then we also congratulate ourselves for making every year, making it go away for 1 year. But is that really, maybe we should have a conversation about that collectively amongst the boards before we send out the budget measures this year. Is the goal to win one more one-year victory while setting ourselves up for a bigger explosion down the road, or should we start whittling away at it somehow?
and the collective bargaining, it's a reminder that all of the 4 units are up the end of fiscal '15, so more negotiations.
Oh, right.
Mm.
Right, so when you said, what was it, 16 or whatever, you structural deficit of, what'd you say, 400,000 at that point?
For
But that-
fiscal '16.
Yeah, but
Right.
that's without these 4
There's no
contracts
COLA,
that
there's no
do
COLA.
come, so what's a rough ballpark on what that might cost? Going on past contracts, and what would be a
Going on the
rough
school
estimate?
settle, basically.
Yeah, the school settled on 6% over 3 years, so, you know, if you do 2, 2, and 2.
Couple hundred, I mean, what
Yeah.
would, yeah,
It's,
so.
you know,
I mean,
200,000.
Yeah.
Yeah, you know that we're gonna end up with a COLA on the non,
Yeah.
non-union side, simply because we don't want to do what we've done in the past years. And fund all the union contracts, but do nothing for the non-union folks.
Right.
We don't want to get in that bag again.
Yeah, and you obviously haven't lost sight of any of that.
Got it.
All up there.
All right. Do we have any minutes to approve? Do we have any from last week? or
They're in
last
your
meeting?
inbox.
Yeah, I read it mine
Oh.
by email.
So just come.
It did.
Good, right.
Looked good to me, it was pretty basic, but if you haven't seen it,
Oh,
you
we haven't seen it, so we'll have to do it next time. Okay, and Marilyn, you don't have any, we don't have any others from you, right?
I was gonna say, it must have gone out about 6:45.
Yeah. All right, well, thank you for doing it, and,
Mine in 2 minutes to 7.
okay, well,
There you go.
guess we'll make sure everybody looks at those, and we'll vote on them next time then. Okay. All right, anything else?
Motion to adjourn?
Second.
All those in favor?
Aye.
Let
Any
Mr. Moore
opposed?
do it.
What?
Good. Let's go.
All right,
Job.
thank you, everybody.
Thank you, everyone. That's a wrap.